All eyes this week are on the latest tariffs drama and results from the German elections. But in Australia, fresh inflation figures will be the focus after last week's rate cut. The US dollar is stabilising, Japan's inflation is strong, and New Zealand posts its first merchandise trade surplus in nearly 3 years. That's coming up in our 5 Things in 5 Minutes on Monday, February the 24th. And then in today's bonus deep dive interview, ANZ Group Chief Economist Richard Yetsenga looks at 2 key issues in geopolitics: whether Trump's tariffs create inflation and how the war in Ukraine might be resolved amid elections in Germany.
We're all goldfish at this point. Every day is a new experience on the tariff bandwagon. We're just taking the news and seeing where it goes.
But first, in 5 and 5 with ANZ, the key figures to watch this week are Australia's initial inflation figures for January, with ANZ Research expecting the monthly CPI indicator to show inflation falling to 2.1% from a year ago versus 2.5% in December. It's all very topical after the Reserve Bank of Australia started cutting rates last week and labour market data showed still strong growth in jobs. Here's ANZ Group Chief Economist Richard Yetsenga.
I think we need to be careful about conflating inflation and jobs. Strong job growth, of course, is something that might make you more cautious on the inflation outlook, but we've had strong job growth in Australia for nearly a year, and wage growth has been trending lower for 5 quarters in a row. So as long as the job growth is being met by higher participation, which it is, participation in the latest data hit a record high, female participation hit a record high, I don't think it should worry you about inflation. The monthly CPI, because it's for January, it's the first month of the quarter, it tends to be a bit downwardly biased, but we're looking for 2.1. So again, reiterating that message that inflation is in the target band.
As of 4 a.m. Sydney Melbourne time, the US dollar index was up 0.3%. The Aussie dollar starts the week at 63.55 and the New Zealand dollar starts the week at 57.40. Number 2, the Australian dollar was firm in the last week despite that rate cut, with the hawkishness of the RBA and US dollar weakness key factors, says ANZ Head of FX Research Marja bin Zaman.
There was not much of a reaction on the Aussie dollar to RBA's 25 basis points rate cut in the end, though the hawkish tone of the bank will likely help keep the dollar supported. Look, basically, the RBA's new forecast suggests upside risk to the labour market, and they acknowledge that there is a resilient consumer and there might be some upside risk to inflation in the long term, given the 2026 December inflation forecast have been revised higher. So all of this really does reinforce our view that the RBA would only cut once more this year and possibly in August. Interestingly, expectations, market participants still seem to be pricing in a May and an August probability of additional cuts, right? Roughly around 50% priced in.
Number 3, the US dollar moves in recent weeks have been a major focus on markets, says Marja bin.
With the US dollar, markets look to have stabilised as tariff risks look to have ebbed, at least for now. I think the dollar needs new developments for a move higher to be initiated. PMIs and activity data is one thing that we are looking out for. We do know that the US dollar has a strong inverse correlation to global growth dynamics. And, over the past year or so, the poor growth environment outside the US has been one of the reasons why we have seen the dollar higher. So any shifts or any convergence on global activity versus the US will likely be dictating the move forward for the US dollar.
Number 4, Japanese inflation figures out on Friday were stronger than expected, with annual inflation in January of 4.0%, up from 3.6% in December. ANZ FX analyst Felix Ryan says that was partly due to a spike in food prices, but underlying pressures are strong too, which the Bank of Japan will be watching closely.
Services inflation look a little bit weaker, down from 1.6 to 1.4% year over year, but again, still quite a firm number and still suggesting that there's some strong services-based inflation there still building within Japan. That was likely to increase if we see those wage rises continue to flow through the economy. So again, I guess another data point supporting our view that the Bank of Japan will continue their policy normalisation going forward.
Number 5, New Zealand reported its first merchandise trade surplus since early 2021 and figures for January out on Friday. ANZ New Zealand economist Henry Russell explains why.
Despite some challenging demand conditions in some of our key markets, tight global supply for our agriculture products is boosting export prices and providing a key support to the economy currently. Import demand also lifted in January, and that's consistent with the recovery in domestic demand that is underway.
Henry Russell there. Now, in our bonus deep dive interview, ANZ Chief Economist Richard Yetsenga looks at two key issues in geopolitics: whether Trump's tariffs create inflation and how the war in Ukraine might be resolved, with a focus on Germany's election results due any time now. Just looking at the wider geopolitical situation, are we any clearer on what's going to happen with tariffs and whether it creates inflation?
We're all goldfish at this point, Bernard. Every day is a new experience on the tariff bandwagon. We're just taking the news and seeing where it goes. I'm less worried about tariffs driving inflation for two reasons. One is I suspect what we will see is a bit of a whack-a-mole tariff policy. If Trump tries to tariff everybody at the same time, I think he will have a stock market problem, which he doesn't want. Everybody I speak to in this space suggests to me Trump does use the stock market as a bit of a barometer, a bit of his own personal temperature gauge. So he wants it to stay quite strong. The other issue is interest rates in the US are still contractionary. Let's remember Fed funds is still at 4.50. The Fed puts neutral at 3. Fed funds hasn't come down very much. When an economy is subject to contractionary rates and you give it a price shock, that tends to weaken demand rather than boost ongoing inflation. Some people are talking about the Fed hiking. That seems a very low probability to me.
Just looking at Europe, how closely should people keep an eye on the elections in Germany and the noise around the war in Ukraine?
Everyone should keep an eye on elections all the time these days. Elections clearly matter much more for economics and matter much more for financial markets. So the last month has told us that, but also the elections in New Zealand came with substantial changes in policy. The elections in the UK came with substantial changes in policy. And this is not just an issue about Germany, of course, Europe's largest economy, but an issue about Europe. It does seem to lack a centre at the moment. It does seem to lack a natural leader. It's not obvious that the outcome of the German election will give us that, but I've got my fingers crossed that we might get just a bit of a centre that Europe coalesce around it as it tries to really form a response against, if you like, two battlefronts, one a literal one with Russia and Ukraine, and the other one, the one that's recently emerged with its NATO partner, the US.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, February the 24th. Catch you tomorrow with a closer look at how China's central bank is doing things off its balance sheet these days. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.